Right now, inflation has fallen off of its highs, but it's still way higher than it should be, while at the same time, our economy is slowing faster than people expected it to be. This is why now we're seeing more and more people get worried about the potentials of stagflation. Right now, today in our economy, we are seeing high inflation and a slowing economy, which are two of the three parts that make up stagflation. The only missing piece of stagflation right now is high unemployment. What stagflation is you can think of it as rising prices and lower wages because people don't have jobs and the economy is slowing. And the last time we saw this type of stagflation was in the late 1970s, early 1980s. And it's a very tough mix of things to heal because now not only are the prices of things rising because of inflation, but then people's ability to buy things is falling because people are losing their jobs and wages are falling. That's why stagflation has always been such a big concern for people ever since the inflation problem started post-pandemic. But this is where now understanding, are we going to see stagflation? How do you protect yourself against stagflation is so important. Right now, our unemployment rate is still low. Our recent unemployment data tells us that we are still at the lowest unemployment levels that we have seen in more than 5 decades. But things are flipping pretty fast. We've seen a handful of bankruptcies, but the bigger concern isn't the bankruptcies that we've seen, it's the rate at which bankruptcies are accelerating. Just like that, we've seen layoffs across multiple different sectors, but the more concerning part besides the layoffs that we've seen is the rate at which layoffs are accelerating right now. This is where you want to come back and look at what some people call the triangle of doom, which is what we are going through right now, where on one corner we have high inflation. This high inflation is making life difficult for people because, well, yeah, inflation has fallen off of its highs, but it's still there, which means the prices of things are rising, which means the money that you're making today can't buy you as much as it could have just a few years ago. So people just can't save as much, they can't invest as much, and they have to spend more money to be able to live their lifestyle. And inflation is still around, meaning that 12 months from now, we could be in a worse situation than today, assuming inflation continues to stay high, and right now inflation hasn't really made significant strides recently to come down. So the high inflation is causing pain to the economy, which is also slowing the economy because the high inflation means people have less ability to spend on other things. The second corner of the triangle is the higher interest rates. See, the Federal Reserve Bank is seeing this pain in the economy, and what are they doing? Well, they're working to raise interest rates in order to bring inflation down. Now, this higher interest rates are a way for the Fed to cool demand because when you raise interest rates and mortgage rates go up, less people want to go out and buy a home. If less people are going out to buy a home, that reduces the demand to buy a home, which helps cool the speed at which home prices are rising. Now, the goal with higher interest rates isn't isolated to the housing market. It's supposed to impact every different part of the economy because people are less likely to get a home equity line of credit and spend money. People are less likely to go into credit card debt and spend money. So the goal with higher interest rates is to slow down spending in general, to cool demand, to cool the prices of things rising, but it comes with a consequence. The higher interest rates also cause pain in the economy. It slows down the economy. And we're facing this at a time where interest rates have gone up significantly over the last 18 months. We've seen interest rates rise from essentially 0 to over 5% in the last 18 months, which is some of the fastest rates we've ever seen interest rates rise. And it's never really been done before where we've seen interest rates rise this fast without causing some sort of economic slowdown or a recession. So now the higher interest rates are also causing a recession, and this is one of the things that we've also been covering very deeply in Market Briefs, my daily financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so because it's a free way for you to stay up to date on what's happening with things like interest rates and the Fed and the economy, the housing market and the stock market, that we're not blindsided by anything. It's completely free. It's an easy to read email. So if you haven't joined Market Briefs and you want to stay up to date on what's happening, it's free, and I got the link for you down in the description below, where you can also go to briefs.co/market. That's briefs.co/market. And then the third part of the triangle is the slowing economy and the higher unemployment. Now, today, we are still seeing some of the lowest unemployment levels ever. Now, there's a lot of things that can be said. People are talking about how the way that we measure unemployment is false and this and that. And sure, that's all true. But on a general level, people have jobs. Are they making as much as they would like? Maybe not. Are people at all the jobs that they want? Maybe not. But jobs are there. But you have to also understand what is going on with the job market. Why are all these jobs there? Because if we kind of backtrack and we go back to what happened in 2020 and 2021 and even into 2022, we saw the most amount of money printed ever. We saw the lowest interest rates ever, which means we saw trillions and trillions of dollars of money injected into our economic system. Some went to people, some went to businesses. But businesses saw this huge influx of cash, which meant we saw a huge surge in the need for labor. And this is all kinds of labor, manual labor, skilled labor, all kinds of labor. We saw this huge need for labor along with the demand because when people got more money, they needed more things. When people got more money, they wanted to spend it. And businesses wanted to invest in their businesses. So when you create the lowest interest rates ever and you inject billions and trillions of dollars into businesses, what's going to happen? Naturally, businesses are going to grow very quickly and they're going to create a need for labor. That's what we're seeing right now. There's a shortage of people. Businesses need people, but there's not enough people out there. And the reason why is because of how much money we created in the last number of years, injected this into the system, and now businesses are trying to keep up with that. And this is where we're going to see a balance happen. As the Fed works to now increase interest rates, it is going to reduce people's ability to spend. It is going to slow down spending. As spending slows down, businesses' revenues are going to slow down. And as businesses' revenues slow down, we're going to see more and more businesses downsize to be able to now mitigate their way through this economic environment. And as businesses do that, you're going to see a lot of changes in the job market. So yeah, right now we're seeing extremely low unemployment. We're seeing some of the lowest unemployment ever. But what got us here? We had a lot of money out there. And when you're given that much money, when you're a business and you're given huge sums of money, you're going to want to use it to grow your business. You're going to want to use it to grow your infrastructure. You're going to want to use it to hire more employees. Well, now we're seeing the downsizing happen. And as interest rates rise, to cool down inflation, it's going to continue this downsizing effect, and that's going to continue going on. And now this is where, well, how long is this going to continue? Well, I was reading a report actually in Market Briefs where my team was writing it down, noting it that the general time frame to see the impacts of higher interest rates are 18 months. 12 to 18 months it takes to see the impact of higher interest rates. So where are we today? We're starting to see the impacts of last year's interest rate hikes. Next year, we're going to start to see more of the impacts of this year's interest rate hikes. So we are working to raise interest rates to cool down inflation. The interest rates rising have brought inflation down, but it has not brought inflation down low enough. That's why we're still seeing the Federal Reserve Bank saying that we might need to continue raising interest rates aggressively because inflation is not coming down fast enough. Inflation is still high, which means not only is it less likely for the Fed to start cutting interest rates, but we might even see higher interest rates. So as interest rates go up, borrowing goes down, which slows the economy more. And so now it comes back to the triangle. We'll still have high inflation. Hopefully it'll come down more. But we have to bring inflation down, because if we don't bring inflation down, that causes all the other issues in the economy and the currency that I've been talking about, where inflation is a much bigger issue to tackle than a slowing economy. So inflation is still a major issue. Then we have the higher interest rates, where it looks like interest rates are going to have to go even higher. If the Fed pivots and starts cutting interest rates sooner, then you can make the inflation problem even worse. If you start cutting interest rates, you can stimulate the economy quickly. You can create an economic boom, but that's going to cause the inflation problem to get worse. Then that brings us to the third piece, which is the high unemployment, which we don't have right now. We still have low unemployment, but we are seeing the economy slow down. After the most recent United States economic report results came in and said that our GDP slowed down way faster than expected. So yeah, we are seeing the economy slow down. What does that mean? Businesses are making less money. If businesses are making less money, they're going to have to find a way to change that. How do you do that? You can sell more stuff, make more money, sell it at a higher price, or you can cut your costs. Now, when you're going through a slowdown when people are struggling to spend because of the high inflation, it's much more difficult to raise your revenue because people have less money to spend. People have to spend more money on their housing, on their groceries, on their travel, and everything in between, which means there's less money left over for them to spend. If businesses have less money left over to spend, or people have less money left over to spend, that puts businesses in a tough situation where they will be forced to cut costs. How do you cut costs? Well, one way to do that is layoffs. And this is where a lot of people have a very short-sighted view of the economy, but this is where I want you to understand as a financially smart person, there's a lot of red flags out there, and this is where it pays for you to be, one, aware of what's happening, but then also take action. And what does that action mean? Well, number one, that means 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. 2023 is the year for you to now put aside some money to do two things. Number one, protect you against an emergency, build that savings cushion. And then number two, build that savings to be able to capitalize on opportunities that might come your way. Because if we continue to see more opportunities, if we continue to see more pain in the economy, that's going to create more opportunities for you to go out and invest in distressed assets at a discounted price. And number three is focus on being prepared. That means investing in a financial education, learning how to invest. There's a ton of free resources out there. There's a ton of YouTube channels out there. There's a ton of blogs out there. There's a ton of books you can read on learning how do you invest. How do you find a good investment? How do you invest in stocks? How do you invest in real estate? How do you invest in businesses? There's so many ways for you to invest, but you have to start doing that, because if things continue down the trajectory that we are now, if we continue to see higher interest rates, that is going to pull down the economy, and we're going to see big changes. No one knows when, but we're going to see big changes happening in the economy. And this is where you want to make sure that you're not blindsided by it, but that you have the ability to capitalize on it. And the only way you can do that is if you're prepared and financially educated. And they go hand in hand, because you can have all the financial education in the world, but if you don't have any money to go out and actually capitalize on an opportunity, you can't buy it. And this is where you want to make sure you're smart with your money today. That way you can capitalize on opportunities that might come your way in the future. If you want to be a high earner or a high achiever, it starts with your mindset. And what I want to do now is go over 10 mindset shifts that you can start making today that all high achievers are doing. And number one is the Blue Ocean Mindset Shift. There's a book out there that I highly recommend you read called The Blue Ocean Strategy. And what the Blue Ocean Strategy